Okay, people coming in, Graham?
Yeah, I think we're good to go, Nick. I don't know whether to say good afternoon or good morning, depending where you are in the world. I think it's 10 a.m. in New York, 4 p.m. in London, and where I'm in Cape Town, it's 3 p.m. in London, I
3
think.
p 3 p.m. and it's dark. It's dark and rainy outside, mate. So probably not as nice as where you are.
It's 5 p.m. and sunny and warm here. So anyway, welcome everybody. For those of you who don't know me, I'm Graham Stephen. I'm the co-founder and CEO of bizvalglobal.com. And, today I'm joined by a special guest, Nick Bradley, who is, he puts us all to shame. He's an esteemed author, podcaster, globetrotter, even a Celtic supporter. So
Far too generous. Far too generous.
But today, as I said, we're really delighted to have Nick. We're going to be going through, how the private equity blueprint, how 7 to 8 figure founders build investor grade businesses. And Nick's just come off the back of launching his new book, High Value Exit. So a lot of the content in
Extra
that,
for millions.
there we
Here we
go.
are.
A lot of content in that. We're gonna cover a bit of that today. As I said, anybody who's attending today will get an e-copy of the book. And if you stick around to the end, we're going to be giving away 5 signed copies of the book. So don't jump off, or if you are going to jump off, come back right at the end if you want to be in the running for a copy of the book. I think just some basic housekeeping. The chat section is set to private, so us as administrators, we can see any comments and questions. So please, as we're going along, feel free to pop any comments and questions into the chat section. We will have a Q&A section at the end, but if it's appropriate, we'll deal with the question as we're going through the discussion. There's also a poll, so if you click on the poll section, please go and answer that poll. Very simple multiple choice question. And then there's a couple of handouts as well in the resource section. So Nick will cover that. There's a 100-day guide, and there's also a link to the BizVal newsletter. So without any further ado, I would like to kick off the workshop. We deliberately called it a workshop and not a webinar because we want it to be interactive and engaging. So as I said, please comment and send your questions in the chat. So Nick, maybe before we get going, perhaps you can just share a little bit about your background. How did you end up in private equity and in the world of scaling and selling companies? Let's start there.
Yeah, so I've actually had, I may look younger than I am. I'm 51. So I've been working in business for 30 years. I started off in the world of corporate. I actually worked for Rupert Murdoch, the News International. And I got involved in some of their strategic growth initiatives, licensing deals, all those sort of things, and started to learn a little bit about M&A through that ecosystem. But again, a huge conglomerate. So, as much as I was reporting into Rupert Murdoch's son, Lachlan, you're kind of a cog in a big machine. But it's a great grounding, right, for lots of different things. I then ended up working for a big UK publisher called EMAP. That's how I transitioned from living in Australia and Sydney all the way out to now sort of living in London. I've been in London now for 23 years. And I was the marketing and strategy director for one of the big divisions of that company. It was a group that the whole group was significant, but the bit that I was involved in was about 150 million pounds of turnover and around 40 million pounds of EBITDA. And it was there that I did quite a lot of deals, a lot of transactions and things like that. And the whole group got broken up, which I'll talk about a bit more detail today. And then I ended up at a place called Getty Images. And Getty Images was the first proper private equity-backed entity that I was involved in. And I managed to be brought into about 40 separate transactions, acquisitions, and integrations, because the whole strategy with Getty was buy and build. Go out there and buy the market. And the very, very, interesting point of my whole career, because that exposure to private equity there allowed me to then get into the whole ecosystem of private equity. And over the course of about a decade, I ended up being a CEO 4 times of investor-backed businesses, led multiple kind of turnarounds and scale-ups and exits. And I was an operating partner as well in one of those PE firms, which we can talk about. So I kind of, once I got into that world, it's hard to leave. I did eventually leave. We can talk a little bit about that.
All the golden handcuffs.
Well, yeah, it's funny. It was a very strategic decision. Long story short, my father had left our family when I was 2 years of age. And he came back into our family when I was in my mid-30s, just before my first daughter was born. And didn't know much about him at that point because I hadn't had any interaction. But he was a very successful entrepreneur. It actually had a business that got blown up in a terrorist attack in Melbourne, Australia, when the Turkish consulate got bombed back in the 80s. And then he had to rebuild himself again, started another business, and that was incredibly successful. So that experience kind of made me think there's a lot of stuff that happens in private equity where founders are taken advantage of in certain situations. It's kind of what I call the dark side of private equity. It's changed a lot, so it's not quite like that anymore in certain areas. But I decided at that point I wanted to jump from one side of the table to the other after realizing that the people that we were taking advantage of were very much like my dad. And he ended up passing away very quickly after we'd reunited as well. So all of this was going on. And so I decided to build a advisory and consultancy to help founders understand private equity, how to build valuable companies so that they can, create wealth, freedom from, the assets that they build from their entrepreneurial journey.
Fantastic. And so today, I guess we're going to go under the hood a little bit, so that the people who benefit from, I guess, these tactics and strategies are the founders themselves, rather than somebody coming in and picking up the business for a song and getting rich off somebody else's foundation.
We're going to level the playing field, as I call it, Graham. We're going to level the playing field a little bit today. And what would be really good, I think, is, as you said, this is a workshop, so I can see any questions and things that pop up in the chat. I will get you to interact a little bit today, everybody, just so we can kind of have a bit of fun with this. But if you've got questions, if something comes up, if you don't agree with something, maybe you've had a different experience, anything like that, just post that into the chat today, and then we can kind of have a conversation as we go through everything.
I see we've got a Sharon, a Canadian in Costa Rica, so we've got a truly global audience here today. So welcome, Sharon and Penelope. And yeah, the name of the book, we'll put that in the chat as well, but it's called High Value Exit.
No, it's Exit for Millions. That's my business, USA. Here we go. There you go.
So I think Nick, just before we get going, last thing, you've kind of touched on that. The reason for writing the book. What was the sort of impetus behind that? And then let's jump into the sort of workshop after that.
Sure, because we'll go through elements of the book today. I'm not going to go through all of it, but I'll go through some of the key points. I started my podcast back in 2019, which was called Scale Up Your Business, and it went to #1 in the UK business charts and was there for like weeks and weeks. And I realized that a lot of the content that I was doing on the podcast was relevant to the kind of full spectrum of what I went through with private equity. And people just kept asking me the same questions. So I thought, you know what, I'm going to spend 18 months, 2 years crafting Exit for Millions, the book. It did take that long. It was almost double the size until we cut it back, because I realized that I don't want someone spending 10 hours reading the thing. It's designed to be read in sort of 5 hours. And it's really a summation of my experiences within private equity. But more importantly, I've called it a blueprint. It's designed specifically for business owners to be able to apply private equity principles so they can build investor-grade companies. And the benefit of that, and we'll talk about it a little bit more today, is the ability to achieve an outstanding exit. But even if you don't, right, the stuff that's in here is what I call the best of the best in terms of how businesses get scaled. And we'll go through again some of that today.
Fantastic. So Nick, I'm going to hand over the controls to you. And I think as the format, as you're going through the workshop, I'll jump in with a couple of questions. Guys, please feel free, jump in on the chat, send your questions through, and we want it to be as interactive as possible. But Nick, without any further ado, I'm going to hand over to you. I think we've done the intros. This is all what have you. So Nick, take it away.
Okay, awesome. And just to answer Gertis's question there, the book is not out on Audible yet, because I actually want to record it myself and do podcasts at the end of every chapter. So it'll be coming out on Audible in 2026. Okay, so let's get into this. I'm going to cover three main areas today. I'm going to talk a little bit about why it's important to be thinking about a business that is built to sell. I'm then going to talk about what private equity is and isn't. And then I'm going to go through some of the elements of scale to sale with a couple of practical exercises for people to do. Now, what would be really useful is to understand, people who are here right now, are you a business owner? Are you an advisor or a consultant? And you want to kind of learn some of the stuff that we do in this space. It'd be great if you could just put into the chat, if you're a business owner, a consultant, those sort of things, and what you would like to get most out of the session today. Okay, awesome. Fantastic. We've got a bit of a mix here, business owners and advisors. Fantastic. Good. Rob said, learn more about systems. Okay, you like the 100-day operating playbook we've got. Fantastic. Great. Okay, awesome. Okay, very good.
Is about to launch, which is great. I mean, we always talk about having that end in mind. Next,
we're going to get into that for sure.
Put the secret sauce before you get going.
So what I'll do is I'll kick off a little bit here just by saying that, serious wealth is not built, in my opinion, by running a business. Some people disagree with this, and I know there are many examples of people who have built businesses that, generate amazing incomes and lifestyles. And that's not necessarily the point I'm making here. I'm talking about substantial wealth creation. And remember, the frame that I'm looking at everything through today is through the lens of private equity. And, there are more billionaires from the entity of private equity than any other entity in the world. And that's because they know how to compound value to create wealth. So we'll talk through some of those points. But if you look around, you kind of see this everywhere, right? So obviously there's Branson, there's Elon Musk, people like Reid Hoffman, who was the founder of LinkedIn. A lot of these people, they created valuable entities, but they created their wealth through selling them or selling parts of them or taking money off the table at different points. So when you think of it like that, one of the things I want to impress on you today, if you are a business owner, is this idea of creating an asset. Okay, an asset that's beyond you, right? It might be something that you create and found as the founder, but it's not something necessarily that you may hold on to forever. Okay, and I often get asked the question about, oh, I don't know if I ever want to exit. I love my business, I love what I'm doing, and the painful truth of that is everyone's going to exit, right? You're not going to have the business forever because you're not going to be around forever. So it's better to be intentional about that stuff from the beginning and give yourself the options. Okay, really, really important. I talked a little bit about my background as we kicked off today. So I want to kind of explain this a little bit more. So I was at this business, EMAP, as I mentioned, a massive UK publisher. And the first time I really started to understand value creation was when this group got broken up. It was actually the last big 10-figure exit before the financial crash of 2008. So EMAP was broken up, and part of it was sold to private equity. Part of it was sold to a big family company called Bauer Media. And it was a transaction that was over £2 billion at the time. What was interesting for me about that is I thought everything up to that point was about building and creating and scaling. What I didn't realize, though, is that value is quite often attributed to what someone else can do with it. And one of the things that I think a lot of business owners do, and this is interesting because you see this as well, Graham, is they think so much about what they're creating and what they want to build and how that's going to support and serve things, mainly their customers. They don't also realize what they're creating, how that could align with another company, how it could align with another entity that has the resources and the strategy to scale it further. And I often say, like, even if you found a business, you're really preparing it for its next part of the journey. And it's almost like giving away a baton pass in a race, right? The more that you can think that I'm building this asset that could certainly survive and grow and scale beyond me, the more you start to become more objective in the way that you think about your business and actually your part in that business as well. Okay.
Yeah, I mean, I love those sort of simple analogies. And for those of you who have kids, it's a little bit like that, right? You're not preparing your kids to be your mates. You're preparing them to go out and add value in the world, whether it's with relationships or partnerships. It's a bit like that with a business, right? I mean, yes, it's your baby, but ultimately you're going to have to let it go, and somebody's going to hopefully find more value in them than you do, which is I find that's something that people often relate to, and it's very simple terminology, but I think a lot of those analogies apply, Nick.
Exactly right. I think one thing about private equity people get confused about, Graham, is actually we love simplicity more than we love anything else, and we favor execution over strategy. So there's a lot of those things we'll cover today because it's an important distinction, I think, for business owners as well. So I mentioned I went to Getty Images. Most people have heard of Getty Images. It's a massive global company. I think it's now valued at over $10 billion. When I was there, I was involved in this transaction where we effectively sold the business to private equity for $2.4 billion. The guy on the left, Jonathan Klein, was my mentor. And I remember when I joined Getty, he said to me, everything you've learned at EMAP and Use International, we don't do that here. We have one philosophy, and that is we buy companies. So while you're here, you're going to learn about mergers, acquisitions, and integrations. And he was true to his word. It was an interesting business. There was thousands of employees, but everything was done. All the strategy stuff was done at the board level. I wasn't on the board. I was a VP. But they built the whole company based on that point of execution. So we managed to scale incredibly quickly by buying businesses that fit within the strategy, integrating them super quickly, and just building so much value in the business. Both Mark Getty, who's on the right, and Jonathan Klein on the left, became billionaires through this whole process. They've actually sold their company now, I think it's 4 times, taking it to private equity, back to public markets, selling it back to private equity. So this is the point around, wealth creation comes from the transfer of value. Okay, the transfer of value. So that's the key thing that I try to say is understand what that means. And then you can start to build a business that creates that option. And the reason that's important is, this is a bit of fun, is that every business, your business as it currently exists today, exists on an S-curve. What does that mean? It means that every business has a point where it's in growth, where it's got momentum, but markets change, external factors you can't control suddenly can have an impact. And so you've got to think of your business not as something that's going to be, around forever, or certainly around for perpetuity in its current form. It has to transform in order to stay relevant and still valuable. And again, I bring that point up because I see a lot of business owners, they start the business, they get this momentum, they kind of think it's going to continue forever, and then all of a sudden it doesn't, and then they're lost. And that's why a lot of businesses, end up becoming obsolete. And here's a classic example of one. If you look at Blockbuster, a business that owned its market, back when people used to rent DVDs and videos and things like that, didn't innovate when it should have. It played defense all the way through, which I've called out here as high risk. And then you've got obviously Netflix who come along, and I think it's only this week, Graham, I think they buy, was it
Warner Brothers, I think for 100, was it 100?
It was 70, 75, it was 70 something billion.
Yeah,
I think that might be pounds. But the funny, there's a couple of memes out there, right, where there's I think it was a 50 million transaction for Blockbuster to buy Netflix back in the day. And if you look at this chart, this chart's obviously not just to talk about those two brands. It's a very used sort of example, but it's this idea that businesses, there's a certain scale, this S curve, and you start to get this growth, this scale. But once a business matures, and I say this to a lot of my clients, you've really got to be thinking about what the next play is, because that might not be with you. That might be you've built something that now needs to go into a bigger entity. And there's a reason why bigger businesses get higher multiples in valuations, because they have more scale and less risk. Okay. So the thing I really want to point out here is that I know some of you will have businesses of different sizes. Some of you will have lifestyle businesses which are generating fantastic income. That's all cool. However, just realize that some of those decisions do create risk. And if the goal is to build substantial wealth or build more sustainability, understanding mergers, acquisitions, and exits is going to be an important part of your journey. Okay.
And it's okay. It's okay if it's not, as long as you understand the implications of that.
So yeah, I don't, no judgment. I mean, a great lifestyle business, I mean, I have a lifestyle business that builds performance businesses. So, I go out there and have equity in multiple companies, but I have other people build them, right? So there's lots of ways that you can do this depending on what your ultimate goal is. Okay. So let's get into private equity a little bit here. Okay. So this is in my book quite a bit, but as it says here, if you don't really understand how sophisticated buyers like private equity operate, how they acquire businesses, you'll be the prey versus the prize. Now you might say, what does that mean? So back in my PE days, when we were evaluating companies, we would evaluate the founder and the leadership team under the guise of prey versus prize. And this is a little bit terrible for me to admit. So I was definitely going to hell when I was in private equity at this point, because a prey business is one that, the business owner doesn't know what's about to happen to them.
Oh.
They think they've got a great business. They don't really understand valuation. They haven't built much value in it, or they don't understand the transferability of value. They don't realize they're going up against an entity that buys businesses every day, and they might be doing a one-time event. Okay. And in situations like that, we would still buy a business in that way, but we're gonna get it on our terms, right? We're gonna get it on our timeline and terms, so that we can then build from the hidden value that's in the business that the founder doesn't know is there. Now, you don't want to be the prey. But the unfortunate thing that I see, since I've been sort of in this world of advising founders, is that most are. Okay. And the reason most are is they get to a point where someone sent them a letter saying they want to buy their company, or they think it's of a certain valuation. They'll hire an investment banker or a broker to kind of do a deal. Nothing wrong with investment bankers or brokers, but they're coming in at the very last point, right? They're there to run a transaction. And once you get into this world a little bit, and you're kind of, in the I'm selling the business or whatever else, it's quite hard to back out sometimes. And my advice, if you want to be the prize, which I'll define, is that you have to start this preparation at least 12 to 36 months before you would start a sales process. Okay. The reason for that is some of the things that drive the most value are the things that take time to build. Like, you can't just transition a new managing director of a division 6 months before you start a sales process. Because if I'm the buyer of your company, I'm going to say, well, that person hasn't been here long enough for me to work out if they're any good, right? So that's a risk, and I'm going to penalize that risk when I think about the multiple and the valuation. Okay, so a prize is a founder who understands how the game is played, has prepared their business well in advance, is going to be a formidable opponent to what we're about to go through, because they have the right people around them, the right deal team, as we call it. And, they're not going to get taken advantage of. In that situation, we love those founders as well, because they're the ones that we back as platform acquisitions. And we want those founders to go and buy other companies to create a bigger entity in the future. Okay. So,
and I think, Nick, if I can jump in there, I think the key point you make there, it's not just about knowing what are the things you need to do to build a more valuable company. You think of it a high-stakes sports game. It's also that you're playing against a professional here, the PE house. Okay, you kind of have to know what are the gaps in your defenses, what are the things that they're going to exploit to basically enable them to buy low. So it's not just about building properly, it's also about knowing what are the weak spots that they're going to use to basically take advantage of an unsophisticated or a seller who lacks knowledge. I mean, I guess that's one of the key takeouts.
It is 100%. And like, we used to joke around sometimes. There's a TV show called Billions, which is worth watching if you haven't. It's on Showtime. And this character here, Bobby Axelrod, is unapologetically about money. And if you realize that that's what private equity is, it doesn't mean you have to be like that, right? But if you understand that's what you're going into, and decisions are made on those sort of almost clinical levels of kind of thinking about numbers, then you are hugely advantaged versus most people, because most people go in there and they just get the charm offensive from the person at the front end of private equity, who's going to do everything they can to take you off guard and get you emotionally attached to the outcome, so that they can negotiate on their terms as they go through. So what I'm going to do now, Graham, is I'm going to go through how private equity works a little bit, just so people understand. It's quite technical, this piece, but I think it's important for people to really understand it.
So, if I may very quickly, just in terms of a time check, I mean, we want to keep about 10 minutes at the end for questions. So we've probably got about another 20, 25 minutes, and then
I'll fly through these pieces. Yeah, that's fine. There's a couple of exercises that we're going to do after this piece, and then we should have plenty of time for that, which is cool. Okay, so private equity value expansion, what actually is it? And in its simplest form, private equity buys a platform. A platform is defined as the first acquisition a PE firm makes within a given market. And then they do 5 separate things, what I call 5 levers. Now, most business owners do 2 of these, right? Sometimes they might do more if they're more sophisticated, but most business owners think about revenue growth and they think about margin expansion. And that's fine, but that's in our world of PE, that's table stakes. That's kind of the basics. What private equity does differently is they're very, very good at structuring capital. What does that mean? It means leveraging debt to scale faster. Even borrowing debt at very, very high interest rates, like 15, 20%, because they realize that they can compound that investment into strategies which are going to drive further growth and value. Now, most founders I work with are very scared of debt. I think the thing about debt is you need to be scared of it if you don't understand how you can leverage it. But if you can put, $1 into something to get 2 to 3 back, then why would you be scared? And private equity don't have that fear when it comes to that. The fourth area is obviously acquisitions. So the quickest way to grow and scale when you're at a certain size and you have the foundations in place is to buy other businesses, do strategic partnerships, go out there and merge if that makes sense. And as I said beforehand, a bigger entity usually has access to more resources and has less risk. It's a little bit like thinking of the big oil tanker versus the tiny, rowing boat in the Atlantic Ocean, right? It's going to take a lot for that oil tanker to get sort of sunk, but the rowboat's probably gone within 5 minutes. Okay, so that scale and that level of resourcing does make a difference. Okay, and then the last piece, which we'll talk about in a second, is multiple expansion, which is the thing that flexes the multiple on the valuation more than anything else. And what's cool about business buying and business acquisitions in my mind is there's no real cap on valuation. So if you go and buy a house in a street in a certain suburb, there's a valuation based on, what that looks like within that region. Even though every market has a range of values, what I found though is if someone really loves what you've built and it aligns with what they're trying to do, I've been involved in transactions which have been significant. Like the biggest one ever was 36 times multiple, where we had proprietary IP in a business and we had a few people bidding for it. And it went for, we thought it was going to sell for somewhere between 15 to 17 times on the multiple, but it doubled that. Okay. Don't panic too much about all this for now. As I said, it's quite heavy going, but it's important to understand this is what private equity thinks like. And they build that value until they create a liquidity event. And everything that they've done to structure that is how they get paid. So I'm going to fly through this, Graham, because it's quite technical, but important. So I learned this at the very cutting edge in my last big private equity gig. I was the CEO of the international division of Ascend Learning. This was sold to Blackstone in 2017, Blackstone being one of the biggest PE firms in the world. And this was 12 acquisitions. It sold for over $2 billion at a 14x multiple. And what's interesting here is there was a bit of sort of organic growth in this, but it was really about packaging all of these businesses together. And I remember that the private equity principal who put this together at a firm called Providence, his take of this deal was $360 million personally, just to give you an idea. So that's crazy numbers, but it's important to understand that's how private equity value expansion works in principle. Okay, so a few technical things to wrap through. So why does that all matter? Why do you need to know this? When you, or if you ever get the position to sell your business to a sophisticated acquirer, the person on the other side of the table is measured on 2 main things. They're measured on internal rate of return, which is effectively is how quickly they can pay back any money they've borrowed from investors. And the second thing, which I think is more important, is what's called multiple of invested capital. And what this is that if let's say I buy a business for $50 million and then I spend another 50 million buying other companies. So I've spent 100 million in total. Okay. I expect to sell that business to either another private equity firm or go public or whatever, and I want to get at least 3 times that investment back. So I want to turn $100 million into $300 million, usually within a 3 to 7 year window. Now, that's an MOIC. So that would be called a 3 MOIC, a 3 multiple on invested capital if I took 100 and made it 300. Now, in my experience, there were much bigger wins than that. So if someone, turned the 100 million into 500 million, for example, that was quite common. Okay, so you've got to always think that if you encounter the private equity world, they're always in the buy low, sell high game. Okay, they want to get your business as cheaply as they can. They want to incentivize you enough so that the performance is driven. But ultimately, they're thinking about how quickly they can pay back investors and how much scale they can drive in that multiple of invested capital. Okay, so let's keep flying through. If you've got any comments or questions on this, put them into the chat. But I'm going to go through a couple of things around multiple quickly. So every industry has a multiple range. Okay, this is a bit of data from Merger Markets, a couple of years old, but the principle remains the same. So if we take education, you can see there that the range is between 5 and 12x on the EBITDA. Okay, so effectively the net profit of the business. Okay, and you might sit there and say, well, hold on, what's the difference between 5x and 12x? If you imagine 2 businesses that have exactly the same EBITDA, and one sells for 5 and the other sells for 12, what's actually going on there? Well, the key thing to understand here is that you can't change the range in the market. Sometimes businesses sell for above the range, but ultimately there's a range that's dictated by the capital markets and previous transactions. But you can influence where you sit in that range. And the way that you do that is by what we call the strategic value of your business. So when a business is, and Graham, you can jump in on this as well. So when a business is valued, the biggest overall thing is the financial performance. Okay, so it's growth rates, it's the level of EBITDA, all that, right? So I call that again the table stakes. But if you want to flex that multiple from 5 times to 12 times, the biggest single thing that decides that is how well you've built the company based on these value drivers. Now, we're going to go through this in more detail in a second, but it's things like the quality of your people and how they're structured. It's the efficiency and precision of your operating model. It's the customer universe that you have, how much reliance you have on only a few customers versus having things like recurring subscriptions and revenue that way. And it's your brand and your culture. And the biggest exits I've ever helped orchestrate have always been where we've become obsessed with building out strategic value, because the strategic value also drives the financial value. So if you build a business that's brilliantly constructed like a well-oiled machine, it drives better financial performance as well. So I'll pause
100%.
there.
And if you look at some of the poll answers that are there, we can see, and the biggest thing, what's holding your business back from evaluation? Lack of systems. So that's the highest one in terms of people who've responded, and then lack of profitability and high owner dependence, which goes hand in hand. So we'll cover some of those things off, but it's a little bit more sophisticated than that below the surface. But ultimately, it comes down to that: can the business run without you? Can it grow without you? And can it remain profitable without you? And everything else is almost
and there is more detail. We're going to go through an exercise in a second. We're going to go deeper than this, but I think my point here is just understanding that these are things that you don't just build overnight, right? These are things that you literally have to plan well in advance. And I'm going to go through Scale to Sale now, the methodology that I used and learned through private equity, so you can learn how to apply it. But some of these principles become very clear as we do that. Okay, so this is the Scale to Sale methodology. So this is how you scale a business to a high value exit. It is in detail in my book. So we're not going to go through all of it today. We're only going to really cover in a bit more detail the first 2 pillars. But I'll run through this quickly so everyone can understand it. So in PE, the first thing that we do as soon as we buy a company is we plan the exit. Right, as soon as we buy it. In fact, as we're going through due diligence, we're already talking about it. We're even thinking about entities that could buy it. And you think, what? How do you know that? Because we're not attached to this. right? We're thinking scale, we're thinking value expansion all the time. And we reverse engineer based on that IRR and that MOIC that I mentioned previously. So if we want to get a 3 to a 5 times MOIC, we know how much value we have to create. We can take that all the way back to the profitability, and we can work out how much profit we need to drive in the business. So let's say the business is doing 5 million of EBITDA, and we want to sell it for 200 million or something, 250 million in the future. We know we probably need to get that EBITDA up to 20 million. So all we're then focused on is how can we aggregate the profitability 15 million over 3 to 7 years. Okay. In order to do that, before we can do the clever stuff, we have to strengthen the foundations. So there's no point scaling, and people hate it when I say this, but I'll make the point. There's no point talking about scaling until you've got the foundations in place, because if you start to scale quickly and you start to do things like acquisitions, the machine will break if you haven't got the foundations in place. So this is also called de-risking. And when we work with business owners, sometimes this can be a period of 12 to 24 months where we have to literally forensically go through the business and make sure that everything's going to be locked down perfectly, so that as soon as we do that, we scale more quickly. And the best analogy I can give for this is the cutting down the tree, right? Sharpen the axe first, and then cutting down the tree happens a lot quicker. Okay. So the third part is the scaling and the building value. I mentioned before, we do a lot of M&A work. We do a lot of strategic partnerships. We're always looking for that, 1 + 1 = 11 type of thing. We're not looking at slow organic growth. As we get close to thinking about transitioning or selling the asset, we start to prepare and profit up. That's not just taking costs out. That's building your deal team. That's thinking about the positioning. That's starting to think about what's happening in the market, because we want to get the timing right. We don't want to just put a business into the market where we think the timing's wrong. We want to try and judge that. And only once we're clear on all of those things will we go to the last stage, which is exit for the highest multiple, where we look to control the sale process end to end. So all of these principles are private equity principles, but as I'm talking through them, you can probably see they apply or can apply to founder-led businesses from the outset.
And Nick, I just want to make a comment here. There's no emotion in this, right? I think that's one of the things that often holds founders back, is they're emotionally attached to the business, whereas a private equity person comes in and they're just looking at the numbers ultimately.
It's even worse than that, Graham. I remember having a treat. They brought in these guys. I think it was armed forces once, to teach us how to be detached. And the analogy here was, if you're in a battle zone and bullets are flying everywhere, and maybe your kind of colleagues are getting shot or whatever, you've got to have courage under fire. So they taught us to be detached when we were negotiating with business owners, because we're talking, in this case, 8-9-figure transactions. You can get all consumed. Right. So remember this: when you're negotiating with someone on the other side, they're pretty much trained to kind of get you attached or get you emotionally hooked, because they know that's a leverage point.
It's like you're up against the FBI interrogator, basically.
Well, there are elements of that for sure. Exactly. So let's go through let's do a bit of work, a bit of exercises now. So I'm going to talk about just these first two pillars of scale to sale. Okay, so the first pillar, clear end game, is really about working back from the outcome. Okay, so you set the intention and then you work back from it. So we're going to do that. So everyone here who is a business owner or aspires to be, you may not be thinking about exit right now, which is fine, but we're going to play a bit of a game. Okay, so we're going to answer some questions. And what I'd like you to do, if you feel comfortable, and some people don't, I want you to answer the questions in the chat. Okay, ready? First question. What is your life-changing number? Now, this is not necessarily $1 billion, right? It might be $1 billion, but that's not the question, right? The question is, if I could cut you a check today, what would absolutely, give you stability, financial security, independence, and you'd be like, wow, that's just the most amazing outcome. Okay, so we've got 2 billions come in. There's always someone who wants to do that. Very good. Okay, interesting. I've asked this question on stages all over the world, Graham, and you get numbers. Normally, the numbers center around somewhere between 10 to 20 million.
Yeah.
Normally, I got a few here. I got 100 million is always good. Okay, interesting. Very good. Okay, so really think about that
Lots
question.
of 10 millions, and the highest one is what, 2 billion that we've got.
Got 2 billion in there, which that's usually I said I love that level of ambition. I do have people come to me who want to work with me and say,
sorry, Nick, I've got this one here. There's a very precise one here: 44,244,442 and 88 cents. I clearly thought about it.
I would love to know if Candace has actually mapped that out fully, because that would be impressive. Cool. Okay, so these questions may seem very simple, but actually they're super important, right? Because what you're doing here is you're setting an intention. Okay, and some people have never thought about this before. They've thought, oh, I'm going to build a business and then sell it one day. Reverse engineer from a number. It makes it so much easier to build a valuable business based on a target. If you sell the business for more than that, great, right? But we want to make sure that you're going to get to that minimum number. Okay, so that's the first question. Second question, right? Even more important than the first question is, why does that number matter? Now, you don't have to share this if you don't want to, but I want you to reflect on it. Okay, because you put a number out there, you thought about it, it was the first thing that came to your head, but why? Okay, so if you put 2 billion down, why 2 billion? Right, that's a big number. Maybe that's about making more impact in the world. Right, Candace's number, why that number? Right, but the question behind the question is about what you become as a result of it. Okay, the difference that you can make, either to yourself, to your family, to the greater world. Because as much as private equity, taught me a lot about the financial side of things, and we said it's about money, it's not about money for the sake of money. It's about what you can do with it. Okay, so really think about these. These are powerful questions. They seem simple, but they're not when you really kind of put some time and reflect into them. And then the final one is what you're doing now in your business, in your strategy, whatever that is, whatever your goals are, is that going to get you there? Because if it's not, why did you put the number down? Okay, unless you're going to do something about it. Okay, so this is important. So again, these are principles that we use in private equity, maybe not as polished as these questions are here today, but the idea is still the same. We want to sell a business for X amount of money in 3 to 7 years. We want to do that because we have to pay back X. We want to make this amount of money, build wealth for ourselves. How are we going to do it? Then we get deep into the strategy and execution. Okay. All right, bit of fun. I'm going to fly through this last bit because I'm conscious of our time, but we're almost there. So the second pillar is strengthen foundations, which is all about de-risking and optimizing. Okay, now this exercise is a little bit trickier because we're going to go through 15 separate entities, questions that underpin a kind of a summary of a due diligence process. So as we're going through these questions, I want you to score your business based on either red, amber, green. Okay, red means I'm nowhere near this. Amber means there's something happening, but we're not quite there. Green means we've got this dialed in. Okay. Now, I did a podcast on this, which I'll share the link to as well in a second, which is called the 15 Reasons Why Your Business Won't Sell to Private Equity. But really, it's the 15 reasons why your business won't sell to a sophisticated buyer for 8 to 9 figures. Okay. So let's go through this. So as I said, we're going to do red, amber, green. So the first question, or the first kind of characteristic is my business high cash flow, profitable and growing with a sustainable growth story? Now, don't overthink this too much. Just read the statement and think, is it red? Is it amber? Is it green? Okay. Second. Okay, good. Yep, keep using the chat, guys. Fantastic. Do I have a brand that's unique and differentiated? Often the top 3 within my defined market. Okay. So a brand is something that creates differentiation, right? Super important. Third, do I have a leadership team in place running the day-to-day operations? Or is it just me? Or even if I have a team, I'm micromanaging and trying to control everything. Okay. Big one. We've talked about this a lot, Graham, haven't we? In terms of that sort of founder dependence, but it's more than just, it's the whole attitude sometimes of that founder. Okay, strong talent across and through the organization, especially key roles that are driving the business strategy. Okay, so how well have you thought about your organizational design and the talent in key areas? Okay, because we'll assess that through a due diligence process. Culture. Do you have a defined culture which is driving or influencing performance? Okay, have you thought about this? Okay. Marketing, sales, and delivery not relying on the founder. That's slightly different to the leadership team in place. Because again, I work with founders a lot who are the best salespeople in their businesses and they don't want to give that up. Not a good thing if you want to sell the company in the future. Okay. Number 7, multiple predictable and measurable customer acquisition channels established. That simply means that you're not getting your growth from referrals alone or one particular channel. Like you might be doing some paid media, you might be doing some organic content, you might have a partnership. It's having diversification around how you grow your business and how you drive leads. Okay. Number 8, reliable low churn business model with recurring revenue with evidence of proprietary IP. So this is quite an important one, particularly because the idea here is that not every business is a subscription business, not every business is a membership, but you can create recurring revenue products and services within almost any business. And the more that revenue is predictable, repeatable, and sustainable, the higher the multiple, the higher the valuation. Okay, number 9, diverse customer base with no concentration risk. So this simply means not having 2 customers that have got 80% of your revenue. It does happen in certain businesses. If that's the case, you have to diversify that. You have to change the business model, or you have to create a new division which is going to get more volume as well as value. Number 10, fully documented systems and processes that will be mapped and looked at very, very heavily through due diligence. 11, KPIs known in place with automated metric tracking. So, do you have a dashboard? I've got a resource in my podcast, which is called the Ultimate CEO Dashboard. It's an episode from about 2 weeks ago. So if people look at my podcast later on, they can download that. But super important to have that in place. And my suggestion with KPIs is don't make it like 70 or 80 KPIs that you don't actually do anything about. You're better off having 5 that actually matter. Okay. 12, audit ready financials. So especially things like quality of earnings. So making sure that you actually have that financial structure in place. 13, a high quality board or advisory team. This is important, particularly if you sell to private equity, because the first thing private equity do when they buy a company is they put a board on you. So if you can prove that you can operate with some level of governance, it's not just you calling all the shots. It shows that you have more of a grown-up, mature business. Okay. 14, at least £3 million or $5 million of EBITDA. If you want to achieve a high value exit. Now you'll hear of businesses getting sold for 2 to 3 times multiple if they've got 500K of EBITDA. I'm not talking about that type of business. I'm talking about a business that can be sold into the big leagues, which can change your life if you get that outcome. So the entry point for a bolt-on is around that number. If you want to start to be a platform, that first acquisition by a PE firm, you want to be pushing above that 5 million mark, closer to 10 million of EBITDA. So if you're a long way off that right now, don't worry. Just think, where am I at and how am I going to get to that stage? Exactly like I said with the clear end game. And then the last one is that you've built a platform that is scalable via M&A, scalable via international expansion. So there are interesting things that you haven't necessarily done yourself, but with new strategies, new resources, new thinking, new ownership, those things could be executed. And what's really powerful, I find, is when someone sells a business, the thing you should never delegate is the growth story or the growth vision, right? You should sell that as hard as you can, because the more that you can do that, the more that the sophisticated buyer is becoming emotionally attached. Okay, because they can see how they're going to get their MOIC or their IRR. Okay. Conscious of time. So that's what this would have looked like, just very quickly, guys. So if you were scoring it, okay, it would look something like this. So if you want to share, just very quickly as we go through these final few slides of the presentation today, how does your business look? Okay, is it mainly greens? Is it a balance? Have you got lots of reds? The most important thing is, have you got more clarity now on the areas that you need to start thinking about over the next 12 months, 24 months, 36 months? Okay.
And I think, Nick, just to touch on that, I mean, obviously we're limited in time now, but I mean, both through the book, which everyone will get a copy of after the workshop, you go into a lot of that detail. And anyone who's I mean, if they want to reach out and kind of understand things further, both Nick and I will share our contact details, and I think that's the important thing. It's about pointing out the framework and then sowing the seeds to ask the right questions ultimately.
Yeah, and as you know, we assess this as part of my business. We assess this for companies, over a very deep 30-day intervention, which then provides the roadmap. So, this is really just to give you a sense today of what you need to be thinking about. If you want additional help on that, then of course reach out for sure. Okay, a couple more slides and we're almost done. So to sort of wrap this piece up, one of the most powerful questions you can keep asking yourself as you're building value over the next few years is, would you buy your own company? Okay, this is again being objective, not being attached. And as you think about that question, right? Would you buy your own company? Maybe you wouldn't buy it now that you've scored reds and ambers, everything, right? I want you to start thinking about the decisions that you're going to make in the future. Okay, so does any decision that you make in your business, is it going to decrease or increase dependency on me? Okay, am I hiring someone that's kind of okay that I'm going to put up with because they're cheap? Or am I going to go and bring someone in who's better than me, that's going to tell me stuff that I don't know and help me remove myself from whatever that part of the business is? Okay. Am I making a decision that's going to increase or decrease my cash flow? Okay. Because again, cash is an interesting thing. You think about private equity in its own right, they want high cash flow businesses because that pays off debt and it also increases the ability to grow and scale. Okay. So if you're making a decision that's going to make you less profitable, for example, why are you doing that? And then, does this decision add obvious value that I can prove? Okay, based on those 15 things that we went through. Okay. So ultimately, as you're going through and building over the next, period of time, think about, would a buyer like this decision or would they not like this decision? And the more you can start to get your mindset into that way of thinking, it will serve you massively. Because I think, this is my final point on this. If you're looking at your business through the perspective of a buyer, it's going to increase the value of your company, whether you sell it or not. Okay. It's going to make your business better. Okay. So really, really powerful. So final bit, this is the podcast episode that I referenced. If you want to have a bit of a deeper listen into those 15 reasons that we went through, so you can scan the QR code. It's one of my most popular episodes. It's about 2 years old now, but it's actually being played in business schools, crazily enough, Graham. Don't know why.
Boy from Sydney in business schools. I'm impressed.
Well,
you may not win the cricket or the rugby, but
no, I think it's just a really simple summary of what people should be thinking about. Maybe, who knows? Cool. So that's all the kind of content in the workshop today. As we said, Graham, do you want to pick this piece up? We said obviously about a copy of the book.
I think so. Two things. We're going to have five attendees will get a signed copy of the book from Nick, and basically the first 5 people who respond with why they would like a signed copy in the chat will win. So either fast fingers or
maybe no one wants a copy. I thought I saw someone just Gertis just ordered a hard copy. Fantastic, but that's very good. I will do the Audible. Don't worry, it's coming.
Yeah. And then everybody will get there is an Audible book. We'll sort that out, and I'm sure we'll make sure that Gertis has got one of the first copies of that, and then everybody else will get an e-copy of the book as well. So just check your emails, and that will come out afterwards. So I think the first 5 we've got so far, and sorry, everyone who's typing now, you've missed the boats. But I'll just call out the names very quickly.
Okay, very good.
So there's an Andre, a Stephen, a C. We'll have to go and see who the email is, an Ashley, and an Obina. So guys, thank you. You're at the fastest thumbs. We'll sort that out. We'll reach out. We'll get the logistics and everything sorted out. But we've got about 6 minutes left, Nick, and I just want to open the floor to a couple of questions. As I say, this is not the end. We can run over a little bit. I know you've got another appointment you've got to get to, but let's take a couple of questions from the floor and then we can wrap up.
Sure. Yeah. So any questions, guys? I mean, obviously we flew through that today and there was quite a lot of technical content, particularly in the private equity section. So I appreciate maybe people haven't seen that. Okay, we've got a few coming in, I think, Graham.
Yeah, there's one here from Andre. It says, "What's the best practice for dealing with partners?" And I'm assuming that's business partners.
Yeah, I mean, I'll answer this in a couple of different ways. I honestly believe that one of the quickest ways to grow and scale is to do things in partnerships, right? I think trying to build anything in a vacuum is challenging. A lot of founders try and do that. Um, I have a philosophy that of fair exchange, fair value exchange, without getting overly complicated in those things. So for me, it's about making sure that everyone's clear on what they're going to get out of the partnership. It's also about understanding everyone's roles and responsibilities, because partnerships break up usually where there's a misalignment of values, right? There's no cultural fit. There's a lack of clarity of kind of outcomes and what everyone's doing it for, or no one delivers what they said they would do. Okay, so without getting legal, I mean, just being human about it, just getting that stuff clear up front, I find is one of the most powerful ways to deal with that.
Yeah, I think there was another question along the similar vein from at Maya. The best way of dealing with co-founders. There's another question here from Andre. Do PE cos look at poorly run companies with good asset value?
Yeah, I mean, yeah, because that would fall a little bit into the prey category. We often just call it hidden value as a concept. Like there are certain things. It could be product services, it could be geographic positioning, could be brands. But we're not going to pay for other people's mistakes. So usually in situations like that, it becomes a turnaround, a distressed asset. So often we will buy companies as bolt-ons to a platform. We wouldn't necessarily go and buy a distressed company as a platform, unless
Yeah.
unless we have the operator we can put in or things like that. But quite often we want to bolt poor performing businesses onto a really strong business and then suck the value out of that.
Cool. Nick, I think we'll take one more question. Everybody who's asked a question and we don't get a chance to respond, Nick will reply via email. So if you have asked a question, we haven't gotten to it. But let's take the last one from Trip, which is, what do you wish you knew 15 years ago that you knew today, Nick?
Where's that question? So what I want to see, I want to read it. Where's it? What do I wish I knew 15 years ago? Oh God, that's a good question. So let's go back 15 years. So I was at Getty Images at that point. Do you know what? It's more of a personal thing, right? I kind of wish I had that experience with my dad a bit earlier on, because it kind of gave me an understanding of how entrepreneurial I am, and also more of an understanding of what I value. I don't think, and I'll be really, really honest here, I don't think I made decisions based on values. I made decisions based on money. And I think longer term, if you do that all the time, it doesn't serve you very well and can actually have negative consequences. So there's that piece. The other thing I think from a practical standpoint is learning the stuff that we've gone through today. I didn't know all this stuff back then. Obviously I was starting in private equity back then, but this idea of foundations and scaling from strong foundations. I've gone into businesses recently and doubled the size of the businesses in 12 months just by flexing the business model and just thinking differently and expansively. And that's skill that I learned from some of the stuff that we covered today.
Fantastic. Well, Nick, it's been an absolute pleasure having you on the workshop with us today, and it's a lot to get through. But I think you did a fantastic job, and to everybody who's stayed for the full hour, we appreciate having you here. It's difficult time zones across the world, so yeah, I think everybody who's stuck around really appreciate it. And if you have any follow-up questions, please reach out to Nick or myself. We'll get back to you, and check out the resource section, check out the podcasts, and thanks for joining us. Hope to see you again soon. Nick, any closing words?
Thanks everybody. Great questions. And as I said, yeah, you're all getting a copy. So read that. There'll be a lot more detail that we couldn't cover today. I normally teach some of this stuff over 2 days. So the fact that we condensed it into 1 hour is pretty good. But thanks, Graham. Enjoyed the collaboration with you as always.
Fantastic. Thank you, everyone. Have a good day. Ciao.